I mean, silver, I think, is particularly interesting because it is the best conductor known to man.
There's an elephant in the room that I wanted to follow up with you on, because everything you're talking about is burgeoning prices and currency inflation, volume of currency, that sort of thing, and how it's being played out in things like oil and other areas, and that you don't see any end in sight because of the supply chain disruptions, the production disruptions, the producer costs, and so on. But what about precious metals? Precious metals, especially silver, can also be considered a commodity, and they have producer costs, and here, especially now at the beginning of 2022, with the Basel III net stable funding requirement coming into scheduled effect, we anticipated, or many people did, that there would be significant noticeable changes in the way that metals were traded, and that if there was not statistical suppression, but actual price suppression of futures going on, that would be muted because it would no longer be as profitable on bullion banks' balance sheets. Can you bring us up to date on what is still causing? We've seen a 2-day push down in, for example, silver prices by approximately 5% here, and people are wondering, how can silver, for example, be the only commodity that's still at less than half of its former high from 40 years ago, et cetera? So help us reconcile your view of silver versus all other commodities in this inflationary environment.
Well, you've got two questions in there. I'll tackle the silver one first. I mean, silver, I think, is particularly interesting because it is the best conductor known to man, electrical conductor known to man. And so with the environmental thing, ESG, environment, social governance, and all the rest of it, everything is being moved away from fossil fuels. It's being moved towards electricity, towards battery power, towards nuclear, lithium. Now, if you look last year, what happened to the price of lithium? It increased roughly 500%, I think, 400 or 500%. Problem with lithium is that you don't really have a futures market so that you and I can go and buy contracts in it and all the rest of it. All you can do is buy shares in a lithium miner, if you like. And of course, the other thing, uranium. I mean, that almost doubled. So why did silver halve? I mean, it just not halve. Sorry, it was down from, I think it was up at $30 at one stage, and it's currently around about 22. I mean, it is completely nonsensical. And there is no doubt that because the system, if I can put it that way, is short to speculators, which is really what derivatives are all about, it has not been in their interest to let the price run away. It's as simple as that. So I think what the story could be for silver next year is that there's a monetary story, which we've touched on and probably will discuss a little bit more, but there is also the industrial use story. So it is just completely mispriced. I can't see that there is the mine production to satisfy the potential industrial demand for silver, let alone the combination of industrial demand as is and investment demand on top. I mean, we're talking about something like 1 billion ounces a year, if you like, of silver, which is mined or recovered from scrap. It's not huge, and it doesn't take a huge amount of money to shift it, as various people in the past have tried to do. I think one of the things that worked badly for silver was this Robin Hood, thing. I mean, sort of various silver bulls, who you and I will know, sort of try to encourage the small punter to, buy a contract or go and buy SLV or one of the other ETFs, silver ETFs, in order to create a shortage in the market. And that created a spike up to 30. But what it did unfortunately, it had introduced an awful lot of weak holders. And so the price has been suffering ever since because, when it backed off from 30, these people who didn't really know what was happening, other than, this seemed like a good idea at the time. They got no other reason really to hold silver. That provided the sentiment background, I think. So that's not been helpful. Now, to turn to Basel III, we're particularly looking at the net stable funding ratio, which is a new regulation which has now been introduced into America, into Europe, and as of the beginning of this month, into the UK. And what it does is it penalizes banks in terms of the funding of the assets of their balance sheet if they use them to have derivatives. It also, incidentally, penalizes them for various other things. So we're not just talking gold and silver. We're not just talking wider derivatives. We're not just talking running bull positions or bear positions in stocks. We are not just talking about, what's the difference between small depositors and large depositors, because there is a difference in terms of how you fund your balance sheet with those two categories alone. So this is a far wider situation than just the area in which you and I and our various followers are interested in. It is not a regulatory requirement for a bank to have, let's say, one approach, one strategy, one business strategy as opposed to another. All we're talking about is how it is funded. So if a bank wants to run an uneven book, whether it's in derivatives or gold, silver, whatever, then basically that bank is going to have a cost hurdle to overcome. And it's the cost of funding it from the other side. It will restrict what the bank can do in other areas. Now, that is already in place. But what it does not do, and this is where the confusion lies, I think, is it does not force a bank suddenly to say, oh, the regulator says we can't have an open position in gold or silver in derivatives, so we're going to close it down. It does not do that. And I think it's very important to get that point over. What it will do, I think, in the long term, however, is that I think that a bank which values its reputation with the regulator might try and become cleaner in terms of its approach under the net stable funding ratio than it is at the moment. So what I would see over a period of time is banks being less involved, if you like, in the wider derivative world than they are today. But this is not something they're going to do overnight. I mean, we're looking at something that is going to take some time, if indeed it happens, because from a bank's point of view, I mean, basically what the Treasury Department of the bank will do is it'll turn around to the traders, say, on the gold desk and say, right, we're raising the hurdle here because of our cost of funding. So instead of us expecting you to make 10% per annum on, the capital that we allocate, we now expect you to make 15. If you don't like it, go away. So, so I think that's what's going to happen. It's not suddenly new rules in place. Everybody's got to comply.
Yeah, that last point you made, I think, is something that I was going to ask you about. Is we've been told by many, Ted Butler and others, that the J.P. Morgan and other bullion banks have had basically an unnaturally successful track record of profitable trades in the bullion space, basically wildly profitable. And so in that context, if you have a business activity that's wildly profitable and where you can basically hit home runs 100% of the time or approximately that, then a 15% added cost of doing business on your funding of it may be just a mild annoyance rather than something that's going to actually shut it down. Is that what we're getting?
Yes, I think that's fair. And while the Bank of International Settlements was tasked with a set of new Basel regulations, which is, I mean, this came out of the Lehman crisis in 2008-9. I mean, I don't think any central bank or monetary authority, I mean, whatever you like to call them, actually wants this to force banks to withdraw from market making of whatever sort it is. They see it as, if you like, certainly an additional cost, and they see it as something which, perhaps gives it reduces, if you like, the systemic risk of the system. So they will welcome these changes, but not to the point where banks completely withdraw from market making and other market activities and derivatives as a whole. Because, I mean, the derivatives are absolutely enormous. I mean, we're talking about, it's come down somewhat, but we're talking about something like 700 trillion worth of outstanding over-the-counter derivatives. I mean, this is absolutely huge. Most of that's in things like, foreign exchange, credit default swaps, and so on and so forth. But, they don't want to get rid of that. What they want to do is just ensure it's not quite so risky, systemically risky.